When setting up retirement accounts, W-2 employees are presented with a major decision: whether to contribute to a pre-tax traditional 401k or a Roth 401k. For W-2 employees, side hustlers, and small business owners, this choice has a substantial impact on both their current tax return and their long-term retirement wealth. A pre-tax 401k reduces your taxable income today, giving you an immediate break on your tax return. A Roth 401k, on the other hand, offers tax-free withdrawals in retirement in exchange for paying taxes on your contributions today. Making the wrong choice can lead to paying unnecessary taxes during your peak earning years. By walking through the key tax implications and mathematical trade-offs, you will learn how to analyze your current tax bracket, project your future tax rate, and choose the option that keeps more money in your control. Let us define the core mechanisms of pre-tax traditional and Roth 401k accounts. A traditional pre-tax 401k allows you to contribute money directly from your paycheck before federal and state income taxes are calculated. This means your current year taxable income is reduced by the amount you contribute. However, these funds are not tax-free forever. When you withdraw the money in retirement, both your original contributions and the accumulated investment growth are taxed as ordinary income. A Roth 401k operates in the opposite manner. You contribute post-tax dollars, meaning your current taxable income is not reduced, and you pay income tax on that money today. The benefit is that when you withdraw the funds in retirement, the original contributions and all investment growth are completely tax-free. It is important to note that historically, all employer matching contributions were required to be placed in a pre-tax account, meaning they are taxed upon withdrawal. While recent tax law changes allow for Roth employer matches, most payroll systems still default to pre-tax matching. The choice between pre-tax and Roth is essentially a bet on your tax rates. If you believe your marginal tax rate today is higher than your average tax rate will be in retirement, pre-tax is mathematically superior. If you expect your tax rate in retirement to be higher than it is today, the Roth option is the better choice. By understanding this core relationship, you can align your contributions with your income trajectory, ensuring you pay the lowest possible lifetime tax bill. Furthermore, pre-tax contributions do not reduce your Social Security and Medicare taxes, which are still calculated based on your gross wages. The tax reduction applies only to federal and state income taxes. It is also vital to know that the IRS sets identical contribution limits for both types of 401k accounts. This means you can choose to put the maximum allowed amount into either a pre-tax traditional account, a Roth account, or split your contributions between the two. Next, let us work through a concrete mathematical example to compare the options. Imagine an employee earning $80,000 a year, which puts them in the 22% federal tax bracket. If they contribute $10,000 to a traditional pre-tax 401k, their taxable income drops to $70,000. This saved them $2,200 in federal income taxes for the current year. That $2,200 is cash they can use immediately for savings or other investments. However, when they withdraw this money in retirement, they will pay taxes on both the $10,000 principal and all the growth. Now, let us compare this to a Roth contribution of $10,000. The employee still reports $80,000 of taxable income and pays the full tax today, meaning they do not receive the $2,200 immediate tax break. But 40 years later, if that $10,000 has grown to $100,000 through investments, they can withdraw the entire $100,000 tax-free. If their tax bracket in retirement is only 12%, the pre-tax option was actually more efficient because they avoided a 22% tax today to pay only 12% later. Conversely, if their retirement income is high and they remain in a 22% bracket or higher, the Roth option saved them from paying taxes on $90,000 of investment growth. This shows that your current income level is the primary driver of this decision. High earners benefit more from the pre-tax deduction, while young workers in low tax brackets should favor the Roth option. Additionally, having a mix of pre-tax and Roth assets provides what planners call tax flexibility in retirement. Having both account types allows you to pull funds from pre-tax accounts up to the top of a low tax bracket, and then supplement your spending needs with tax-free Roth withdrawals. This dual approach keeps your taxable retirement income low while allowing you to access significant capital without triggering higher tax brackets. We review the decision checklist and reporting rules for these contributions. When making your choice, follow this diagnostic process. First, identify your current federal and state marginal tax brackets. If your combined marginal rate is over 25%, pre-tax contributions are generally the default choice. If your combined rate is under 15%, the Roth option is highly attractive. Second, evaluate your career stage. If you are in your early career and expect your income to rise significantly, pay the tax now via Roth. Third, consider your state of residence. If you live in a high-tax state today but plan to retire in a state with no income tax, pre-tax contributions save you state tax now that you will not owe later. To verify your contributions, check box 12 of your W-2 at the end of the year. Traditional pre-tax 401k contributions are reported under Code D, while Roth 401k contributions are listed under Code AA. If your pay stubs do not match these codes, notify your employer immediately. By systematically evaluating your tax rates, career path, and state rules, you can optimize your retirement contributions and protect your wealth from unnecessary taxation. Be sure to review your contribution settings during open enrollment, or whenever you receive a significant raise. If you find yourself right on the border of a tax bracket, you can calculate the exact amount of pre-tax contributions needed to pull your taxable income down into the lower bracket, maximizing your current year tax savings. This deliberate management of your retirement accounts ensures that you are utilizing your employer benefits to their full potential, keeping your current budget balanced and your long-term retirement plans on track. Tax Season School helps freelancers, W-2 employees, side hustlers, and small business owners understand tax deductions, forms, deadlines, and common filing mistakes in simple terms. This channel is strictly for educational purposes and does not replace the advice of a licensed CPA, tax professional, or attorney. Always consult a qualified professional before making tax decisions. This video is general tax education, not professional tax, financial, or legal advice. Tax laws vary by state and individual situation. Always consult a licensed CPA or tax professional.